Today is my birthday, but don't worry, everyone. I'm not looking for a present or even messages of happy birthday. In fact, I'm going to share something with you which is worth more than any present. I've got some explosive changes to how we trade. Throughout my corporate career, I've always depended on forecasts. No, not weather forecasts, but forecasts of sales, forecasts of how many people I'm going to need, how much machine capacity, how much raw material, how much stock. That came from the very seasonal mail order business. I was a director at GUS. We owned a whole range of different mail order catalogs. And the people who did that had to forecast for the season. And they had to give orders to manufacturers for stock. And they could tell within the first few days or a week or so of what the total sales were going to be for the season. They learned from the record producing industry, the CD selling industry. In that industry, they had to take the first few days of sales and predict how high the graph would go and how long it would last. And that's how many records they could produce. To get that wrong was hugely costly. Now, that corporate world was tough. If you consistently got the forecast wrong, you got fired, no question about it. So let's come back to the world of the stock market. And I'm looking here at a stock which is AAON. I've looked at dozens. This one happens to be alphabetically the first one we come to, but the story is the same on every one I've looked at so far. Now, this looks a bit complicated, so let's break it down a little. So we've got a chart here, a graph, and it's the average selling price of the stock at AAON. And it's over a period going back almost 4 years. That's as far back as the value line reports will take us. We could look at the stock going further back, but lots of other data would be very difficult to dig out. So together with my team, we'll look back to the beginning of 2020 to see what was being forecast for the price of AAON for 18 months later. And we've done that moving forward a quarter at a time. So the yellow line on this chart is the forecast, and it's the high forecast. They give 3 18-month forecasts, a high, a middle, and a low. The high doesn't look too good. In fact, it's been nowhere near. On screen, you can see a figure, R equals 0.4536. That is a measure of correlation, the relationship between these two sets of data. A perfect relation, if the lines were running exactly in parallel, would be a score of 1. A random relationship, so no relationship at all, would give a score of R equals 0. So this score is less than halfway up that scale, which I'm not impressed with. This is the middle forecast, R equals 0.4586, exactly the same correlation. All that's happened is the line has shifted down a little. It's still not giving us a very good indication of what this stock was going to be doing in 18 months' time. And this is the low forecast. Again, the same correlation almost, 0.4584, and it looks as though it's doing a better job, but really it's not. The relationship is exactly the same. So what that's telling me is that the forecasts that are coming from Value Line are not very good. And that's not just for this stock, it's for every stock that I've looked at so far. Value Line also do a 3 to 5 year forecast. I've actually taken it as being a 4-year forecast for the ease of doing the figures. And perhaps that's not going to be so bad. I can't imagine why. I'm sure that's random, especially if you look close in to the beginning of 2024. But going further out to 2027, wow, there's some figures there. I certainly won't be relying on that long-term forecast. But let me show you something else. The two lines on this chart represent an index of the S&P 500 and also of the NASDAQ. And they look much closer together. They are closer together. The correlation on these is 0.68. So almost 70% towards perfect. I don't want perfect. I want to be able to identify stocks that are moving more quickly, growing faster than either of these two indices. As it so happens, this particular stock, AAON, has a closer relationship to the S&P 500 than it does to the NASDAQ, even though it's traded on the NASDAQ. Here you can see the price, which is the blue line, and also the S&P 500, which is the sort of orange line. And there are periods when the price is below the S&P 500 and then above. Now, the fact that this has happened is going to give us some good indications that there are great times to enter this stock. When the blue line, is a long way below the orange line, it's a good time to go. There's a fair chance, more than a fair chance, a 70% or so chance that the price will move back up towards the S&P 500 line. Similarly, if it's running ahead of it, as it is at the end, so we've got the blue line for the price above the orange line for the S&P 500 index, then something else has got to happen. Either that price is going to fall and come back towards the S&P 500, or the S&P 500 has got to move up towards it. One of those is going to happen. However, that we can decide at the time. We don't need to make a decision about that. And the other thing is that decisions to enter these stocks or to exit them are not to be based purely on this information. This is only going to provide us with a watch list. The watch list, though, will be a watch list for getting into and a watch list for considering getting out of stocks. Here is the chart for AAON. And looking at this, you'd see that the indicators look pretty good, and also the price seems to be at a low, and it's perhaps turned, although the last candle is negative. And from that, you might decide to get into this stock. If you look at it on a weekly basis, you can see there's actually a long way up. There's a long way to fall there. The risk to reward ratio might not be too good for getting into it. So that's telling me that the information we had by comparing this stock to the S&P 500 was actually correct. If we're going to get into it, we should have done so quite some time ago. This is not a time to be getting into that stock. It's a time to be considering getting out of it. So looking at this again, the further apart these lines are, the greater the chance that they're going to come back together to some degree. So when the blue line and the orange line are furthest apart with the blue line below, that's when I want to get into this stock. However, I think it's not an instant only today decision. Each of the points on this chart are actually 3 months apart. So there was a whole period of about 4 months when it would have been good to get into this chart. We can refine that decision by looking at the indicators and the charts, the actual stock chart, when we're in that period. That's the time to use the indicators. It seems to me that the indicators are very good, but only for short-term use. We're looking at indicators and saying that today they're all lined up. And yes, that's good. And it looks like the MACD is improving and the RSI is improving, and we're getting the V's and everything else. But that could actually change again within a very short time. If we're looking to just trade very short-term profits, that's absolutely fantastic. If we're looking to build a portfolio to live with for a long time, and also one that we're going to create a steady income from, then I think this is a lot better, and I hope you agree. I should point out that the figures that I've used on here, well, first of all, they're indices, so they're not actual prices, and they are based on average figures. So for each quarter, it's the average price of the stock. For each quarter, it's the average that the S&P 500 was stood at. So within this, and again, using refining techniques, there will be periods when that gap is even larger. When the S&P 500 happened to be at a high and the price happened to be at a low end of the figures that created the average for the month. So there's a lot we can do with this. So I've worked out for this particular stock, if we can get a difference between the two lines of about 20 points, positive or negative, then we should be putting the stock onto a watch list for getting into or getting out of. I can produce a mechanical watch list for that. It'll look something like that across on the left of this slide here. Stocks that look good to get in and need to go on the get in watch list are highlighted in green, and those that we should be looking at considering getting out of have not actually got in red. It's not danger. I've tried to get them in something approaching amber. Simply take care, have a look at them. I think you'll agree that's absolutely powerful stuff. Now, coming soon, I've got a new publication coming out, and it's going to produce this watch list, and I can actually produce that even on a daily basis if people want it, but probably on a weekly basis. And it will also give some in-depth analysis of the stocks that come up. As is shown here, they'd be called something like the blue sheets. Now, you can get into this, you can get a subscription to this. Everyone who attends the TICN live event in Derby, coming up on the 1st to the 3rd of December of 2023, will get a free 1-year subscription. You can book the event at myinvestmentclub.co.uk. Thereafter, subscriptions will be available by paying. Thank you for your time, and thank you to my team. I hope you got something useful from this. It really is going to change how we trade.